Good morning, everyone. Today is a lovely Saturday morning on January 9th, and in the past week, there's been a lot of activity. Pushing aside the current events that have happened the exact last week, I'm here to actually talk about the second round of COVID and stimulus bill that passed in late December. So I'm going to put up some slides here and we're going to begin. And this is designed to be a quick video. And the first part's going to be mostly targeted towards individuals. The second part will be targeted towards businesses. Being that if you're a business owner, you probably will have both elements here of individual and business impacting you. Whereas if you're an individual and without a business at all, you are free to leave within after we get through the individual portion, if you're not interested in the rest. So I designed this to be a quick, about 15-minute video, so that way you can get the CPA's guidance on how the law change impacts you for taxes coming up in this filing season. So without further ado, we're gonna share my screen here, and we're gonna share you should be able to see me now. You'll see the second COVID bill stimulus, as well as myself. So you get to listen and see me for this Saturday morning briefing here. As you know, I've started doing some of these videos because I find that they're quick ways. You can listen to them. You can be out and about, and to get practical thoughts on, from a CPA here at Horton CPAs. So we're going to discuss the individual provisions in what's called the Consolidated Appropriations Act. A lot of people call it Stimulus Part 2 or PPP Round 2. There's a lot of different names. Now, the Consolidated Appropriations Act is essentially the U.S. budget, and just like anything, it's tucked, a big, thick stack of paper tucked inside that budget bill. And to be honest, it's over 5,000 pages. So we're going to boil down the most relevant sections to you, because there are some unique items that we won't discuss here, such as like the new markets credit, but we want to make sure to accomplish that most of the people who would be listening to this are up to date on information. And then we'll go over business and then some FAQs or frequently asked questions that we at Hortonist have been receiving. So a little bit about myself. You may already know me. My name is Gennaro Carteropoli. I'm the current presiding president at Hortonist CPAs. I worked as a tax researcher in the past, so meaning that when it came to staying up on the bills, passing, or any new tax laws and how it operates, that was my job when I was there. During that time, I built up my own practice as well. And I also worked at a large public accounting firm at Grant Thornton. So essentially, it's close to one of the top, it's certainly in the top 10 accounting firms in the United States, if not the world. So without further ado, let's talk about the individual stimulus. And here's where we've actually had a lot of questions. And some of you might probably already have the stimulus deposited in your bank account. And it's $600 per adult, $600 per child under the age of 17. It's effectively tied to the child tax credit rules. And for those who aren't familiar, you have to claim the child, and the child also has to be under age 17. So right there, I hit a lot of questions before we even touch the FAQs. Is 17 and 18-year-olds, how do they qualify for the stimulus? And the short answer to that is they don't. And the reason being is that if at age 17 and 18, you're technically still able to be claimed as a dependent for about 9 out of 10 times. There are some exceptions. I won't go into all the exceptions in a video like this, but but generally they will not qualify for stimulus. Now, the stimulus, both Part 1 and Part 2, can be claimed on your 2020 tax return that you're about to file if you did not receive the full amount, or if you were shorted, or if you had a child that wasn't accounted for. There could be various reasons that you can qualify to claim it on your tax return. Now, there is income eligibility. So in a short, if you're married filing joint, once your AGI is over 150,000, the stimulus starts phasing out. In addition, if you're single, that figure is 75,000. So if you got a pro rata portion that didn't make sense, chances are that you're in that phase out range. So you might want to check your 2019 tax return to see, if that is accurate. Good news again is if you're shorted because of your income in 2019, but your income dropped like many did in 2020, you can claim the rest on your tax return. One thing that's big for those, especially those in the low income that completely lost their job, is that there's people who had reduced income workers in 2020. They may lose out on some otherwise important credits, such as the earned income credit and child tax credit, or the refundable portion thereof. So, to give a short reason why that's important, there's some people who make maybe between $20,000 to $40,000 in wages or self-employment, and that's important when you have kids because it helps with the child tax credit and earned income credit because those are tied to what's called your earned income, meaning wages and self-employment. So essentially, a nice short way to think about it is anything subject to Social Security taxes. So having said that, some people might have just completely lost their job in 2020. So you have a choice where you can use your 2019 income for the purpose of these credits. So we've had a couple people who have zero income because they're in the unfortunate position that they've lost pretty much all their earnings, and they would otherwise not qualify for any credits from the government. There's an election that can be made to reinstate those credits. Other individual tax provisions. So medical expenses, we're at 10% of income. They dropped that back down to 7.5%. After 2020, the tuition and fees deduction is going to be gone, and they're going to actually increase the education credit income thresholds. So you get a credit if you go take higher education, or your kids do. And there's a lot of people who are getting phased out easily to not get any benefit from education. So after this year, and rightfully so, in my opinion, they're increasing the income threshold to allow more people to qualify and expand that. There's also the forgiveness of debt on a principal residence. So if your home is foreclosed or taken, or your debt is modified on your home, prior to the passage of this, you may have actually been at risk to pay tax on that income. Because cancellation of debt is actually income. So if you owe $100,000 on your house and the bank lets it go, the government wants you to pay tax on that, and they are, so you might think, well, I didn't get any cash. Well, the only thing fair in taxes is fair market value. The government, I heard a great joke that if you ever ever thought about taking the words D and IRS, you put them together, it spells theirs. So they're very aggressive in pursuing that. But with this forgiveness of debt exclusion, a lot of people who may have been in unfortunate circumstances are forgiven without tax. Expanded charities is kind of a big one. The expanded charity, you can now take a charitable deduction up to $300 or $600 if married, filing joint, whether or not you itemize on your tax return. Itemizing means that you tally up all your personal expenses and compare to the $24,000 something odd change that the government gives you. And you take the higher of the two. So a lot of people under this new tax code that's been in effect since 2018 are stifled or undermined being able to take this deduction. This allows them to take it, and it's a nice little feature. They do increase the penalties for fraudulent claiming of charity, so make sure you have your receipts. And in addition, if you go above the $600, you can still claim charity so long you otherwise itemize. Now, and lastly, in this one I call window dressing for PPE for educators or personal protective equipment such as tissue boxes or disinfectant. They are allowing that as part of the deductions that educators or teachers can deduct. But I call it window dressing simply because the cap on the total expenses you can take and as an educator is $250. That's been the same for decades. So the unfortunate part about that is that despite all of that, chances are with the equipment and supplies teachers buy anyway, they're already at that $250. So if you're still limited to $250, it's not going to increase you anything further. So they really need to focus on increasing that deduction threshold if they want to make this meaningful. But unfortunately, it doesn't. I wouldn't focus too much on that. So this is where people come in. They say, "Hey, I heard I can take this deduction for this." Yes, but you're already capped at $250 for education expenses. So the additional amounts you spend aren't going to increase your deductions. Frequently asked questions. My 17-year-old doesn't get a stimulus. Does they get a stimulus now? And the answer to that is probably not. So remember what I said, that 17 and 18-year-olds tend to still qualify to be claimed as a dependent. Now, if they file their own tax return, which they can regardless, and I should be more specific to say, and claim themselves, because a dependent can file a tax return and can sometimes be required to, even in some cases. It doesn't mean that they are not a dependent. Dependents can file tax returns. In fact, one of my favorite tax returns was, for a 12-year-old who had a trust fund and they still required to pay tax. Fun story. I can talk more another time in person. But focusing more on this is that the fact remains is that if they are dependent, they don't qualify. If they do file their own tax return for 2020 and claim themselves, they will likely get that stimulus on their tax return. Now, I'm not going to go down the route of whether it's accurate or not. There's certain provisions or things that need to be done. The government, if it's an erroneous stimulus, has very limited capability of reclaiming that. So what I can say is that based on tax law, if they qualify to be a dependent, they don't qualify for the stimulus. So also keep in mind that if you let them claim themselves, such as let's say a college student who's age 20, keep in mind that if you want them to get their stimulus and you say, hey, go ahead and claim yourself, I'm not going to comment on whether that's right or wrong at this point. I'd want to have a discussion with you in person. But presuming it's wrong anyway, and that it's intended that the college student is trying to get the stimulus, that's going to cost you as a parent. If they're in college, you might qualify for the American Opportunity Tax Credit for letting them go to college. You do that, you don't get that credit anymore. How long will it be before you get our money? A lot of you should already have it. If you do not, they may be sending you a check. After that, the IRS doesn't seem to be intending to issue any further stimulus payments after January 31st. So at that point, the IRS says claim on your taxes if need be. So that's why I say when people say, how long will it be before you get your money? If you're holding your breath, bring an extra pair of lungs. Can I get direct deposit for stimulus part 2? If you had it for part 1, you'll probably get it for part 2. Otherwise, they'll send it to you via check. Make sure to go to Get My Payment at irs.gov to follow up the status on your stimulus. There's not much that we can personally do to follow up with these guys. The government goes at their own pace and beats to their own drum. But if we may be able to answer questions you may have regarding your stimulus. And if your income dropped and you didn't get any stimulus, you can potentially claim parts 1 and 2. So that concludes our individual portion. And I'm going to start going on to businesses. So if you wish to end, feel free. I won't hold anything against you. But I did want to start going over onto businesses. So businesses, there's the sick pay credits for COVID-related claims if your employee or yourself is sick. That's extended through March 31st of 2021 as far as being able to claim the credits. So the unfortunate part is it seems that if the employee used up their hours in 2020, they don't get anything further in 2021. The law simply states that they're expanding the time frame to claim the credits, not whether or not the hours reset. So by default, absent of further government guidance, unless the government decides to more liberally apply that, which the Department of Labor and IRS haven't put forth any further guidance, an employee doesn't get any further sick pay, unless they still have some carrying over from the prior year. So that's one piece to keep in mind, that if you decide to offer it yourself, it may very well be on your own dime, if they've already exhausted it in 2020. If they have not, you have until March 31st, 2021, if they become ill or quarantined, to claim that credit. PPP, that has been the biggest buzz for businesses. And, so one of the biggest things that you'll see is that the PPP is now completely tax-free. Before the government was going to take away being able to claim deductions for the PPP money. Now they are rendering it completely tax-free. So you get to have your cake and eat it too for this particular circumstance. So if you've applied for forgiveness and originally thought it was going to be taxable, congratulations, you now don't have to end up paying tax on any PPP proceeds. Also, the 50 to 150 is there's these under 50,000, there's a simplified procedure for claiming for forgiveness, or I should say simplified form. You still have to go through, your calculations to make sure that you qualify for the forgiveness, or you didn't have any FTE reductions, or I should say employee headcount reductions, etc. But if you're under 50,000, it's a simplified, pretty much check the box, and they're going to expand that to $150,000. So having said that, many banks beyond 50 but under 150 are saying, hold off, we need additional guidance from the SBA. Now, there's also a second round of PPP, so meaning you can take another draw of PPP money. So keep in mind, if you never got round one, you are also available to take part of this PPP. Effectively, there's some money left over from the PPP round one that they repackaged it and added some more funds to it. And if people who missed out on a deadline to apply still have a chance to do it here. Essentially, they're going to separate it into the first draw and second draw PPP, and that's what will determine what your eligibility is. So as far as eligibility for round one, it's the same, but for round two, it's similar to round one, but has some additional modifications. Number one, you have to have less than 300 employees per location. The biggest one that I find is that at least 25% in reduction, or you should need to have a 25% reduction in revenue, I should say, in one of the quarters relative to 2019. You can also have a fourth quarter, there's a lot of different, because the fourth quarter just ended. But any case, if you have a 25% reduction in revenue, and that's important, revenue, not net profit, then you're eligible to partake in round two. So they're more narrowly defining this to get people, who suffered economic hardship to qualify, as opposed to the more liberal or lax guidelines that originally put forth. Another thing that is important and that I could easily find this being missed a lot, is the retention credit. Meaning if you had a dip in revenue and you paid employees and you're a small business, you may be able to claim a credit against your payroll taxes using the retention credit. Before, if you took a PPP draw, it's gone. You don't get any more. Now they said you can take both, and even retroactively, so long that the second round, or I should say, let me rephrase, so long that you're not double dipping, meaning that you're not claiming a credit on wages that you paid with your PPP funds. So the IRS has to issue some guidance at what we can do, because I foresee, some people like in quarter four that would qualify for the retention credit, or quarter two or quarter three that that they exhausted all their PPP funds. So does that mean you amend your 941s or your tax reports? Does that mean can you claim it now instead? That's yet to be announced by the IRS. As is, it would seem that you'd have to amend your prior payroll reports, but that's very cumbersome, especially if you just issued your W-2s. So having said that, Stay tuned. I foresee that the IRS might end up putting in forth something like they did last year, where they might have an extra line item on the 2021 941 to allow you to claim the missed wages from the past. But I can't say that for sure. It seems like that's the way the IRS does it for administrative convenience, because imagine they don't want all these amended returns either. So stay tuned on that. But I don't necessarily see, you still have to issue your W 2s in time. You still have to issue your W 2s. You cannot delay those. So the worst case scenario is you amend the 941s to claim the credits, and that shouldn't really change your W-2 amounts. So stay tuned on that. Some questions we received in regards to a lot of the stimulus for businesses is, can I get a round two? And absolutely. What if and now here's one thing is question number 2 here is, what if my wages, or let's say, wages or self-employment was higher in 2020? Can I use that for the PPP? And yes, in actuality, this new round of PPP lets you choose between 2019 or 2020 for the most part, in claiming what the amount of payroll cost is. Remember, it's 2.5 times your monthly payroll. So you can choose 2019 or 2020. That's a great deal because essentially that lets you choose the better of your two options. Now, do sick pays reset in 2021? No, it does not appear so at this time. If there's more Department of Labor guidance or IRS, I'll be sure to put together another, alert. But at this time, I'm not seeing any sort of reason why they reset the sick pay hours in 2021. So another question we got that was interesting was, what if I expanded and I should have seen an increase of 25% in revenue, but it stayed stagnant? So let's say you expanded, normally your gross receipts would be 500,000. You're expecting to have 625,000 in revenue, but instead you had 500,000 like last year. You took on the additional expenses. So can I get that PPP? And unfortunately, it seems like a no at this point, because they're looking at your gross receipts in comparison to 2019, not your opportunity cost or what you lost out on because of COVID, if you expanded. So unfortunately, we're looking at 2020 compared to 2019. Can I stack my PPP? So let's say I get I want round one and round two because I didn't get round one. So I want PPP, PPP. That's a little bit too much P there. The government isn't going to allow that, because part of the criteria for round two is that you've already taken and have utilized the money or will utilize the money from round one. So you have to have had a round one already in order to apply for round two. So there is, however, some guidance that looks like it's being released that if you underclaimed your round one in some circumstances, that they might let you tack that on to round two, meaning to make up for what you could have gotten. That was only a few unique situations in the SBA guidance released about 3 days ago. So more guidance is needed from the SBA and is intended to come out next week. So stay tuned on that. Now, one big one is I heard my EIDL or EIDL advance not required to be repaid. And for those who don't know, and is that the EIDL advance is when you applied for this short-term funding, it was about $3,000 to $5,000, or I should say 3 to 5. It could be 3 to 5. It could be up to 10, essentially, that you got through the SBA. That originally the government was going to require you to repay that upon the forgiveness of your PPP loan. So some people got a $10,000 advance from the government like that, and then they went around and applied for PPP. And then upon forgiveness, found out that the government says, hey, we gave you too much money. We want that $10,000 back. There's a little provision tucked away deep into the law that, for the unwary, they stumbled across. The EIDL advance is no longer required to be repaid upon PPP forgiveness. That's great. And for those who already had your PPP forgiven from round one and the government said that you owe, or the bank told you you still owe 10 grand, for example, plus interest, stay tuned. I expect there to be additional guidance issued on that, or the bank may reach out. But the because it's retroactive, it by default now has to be forgiven. They just haven't announced the logistics about it. So we know it's supposed to happen. They just haven't put forth the paperwork. So it will. So that's great news there for those who got the advance and were surprised with the bill on the back end. So with that, thank you for sticking by through this whole video. And I know we went above and beyond the 15 minutes, and I tried to keep things concise, but my goal is to provide good information to our clients and anyone who's listening, honestly. I have a passion that people have correct information to make correct decisions in your financial lives. And that goes for finances, taxes, accounting, management, etc. So thank you for taking the time to watch this. You have a wonderful weekend and stay warm this winter.